Good morning, everyone. Bill Ulivari with Cenacle Capital Management. We want to wish you a very happy holiday, what's left of it, and a happy new year going into 2022. Today is Wednesday, December 29th. It's a little right around lunchtime, and I just wanted to go through a couple of quick charts with you and give you my take on the market. So for 2021, I think most accounts, with the exception of our technology-heavy accounts, did pretty well. I would say that every account, without exception, had a good year, but the highs were made in March and April, and I'm going to show you why. We've had some really interesting developments going on under the currents of the water. So let me share with you my screen. And this first chart I want to show you is the U.S. Treasury 10-year yield. In other words, what did 10-year interest rates do? What's considered the risk-free part of the interest rate curve. And I don't want you to overthink the charts. Don't question too much. Just whatever. It's like a Rorschach test. Look at the image, and whatever you immediately think is kind of how I want you to run with this. So you can see that we had interest rates in the high 2s to low 3% coming into 2019. We had a big rug pull when the market began to decline at the end of 2019 going into COVID and 2020. The lows in interest rates, as you can see, were down at the 0.4%, like less than 0.5% in the 10-year yield. And since then, since March, April, May of 2020, we've had nothing but higher interest rates on what's called the front end, the 10-year curve. Same thing with other short-term rates. So for the most part, I do believe, and we've made a generational low in 10-year interest rates. And I know that you've heard me say that before, where interest rates were 19, 20, 21% in 1979 and 1980. And here we are at 0.40 this year. So I think it's done. I mean, and even I would say that interest rates, inflation, again, we're still kind of wrestling between transitory and it being a permanent fixture in our economy. But I'm not seeing it right here in interest rates yet. So don't take a little bit of this, of the grain of salt, the news about what you hear on interest rates and inflation. It's high, but it isn't, I think, a deal breaker yet. Here is the 30-year U.S. Treasury bond fund. This is an index that is the long end of the curve, way out in 30 years. And as you can see, interest rates decline into the COVID-19 in the spring of 2020. And since then, we've had a really great rally in interest rates, right? This is not always a bad thing. It's kind of a good thing, with the 30-year rates at around 1.95%. But we've had a decline again recently in interest rates in the long end of the range. So what's happening is that the front end is at 1.9. I'm sorry, the front end is at 1.45. The back end, long end, is like 1.95. So it's kind of flat-ish, which I'm not going to say is recessionary. I'm saying that it means kind of like slower growth. So we have to watch not just interest rates as they go up and down, but how this teeter-totter shifts between the front term 10-year rate and the long-term 30-year rate. And that gives us an indication of how the economy is doing. So right now, I would say slow growth going into 2022. Here is a chart of the Russell 2000. This is 2000 of the small companies, the largest of the small companies in the United States traded on our exchanges. And for the most part, yeah, it's up maybe 13%-ish for 2021. But honestly, it has provided virtually no bottom line indication, any bottom line help to our portfolios. So we really have not been in the Russell 2000 for a while. We did get in a little bit in the spring of 2020. Mostly what we did is we avoided growth, IWM as in Mary, and got into value, which is IWN, like in Nancy. And I think for the most part, I would say that the returns were better in 2021. And it certainly seems to be a little bit stronger. We had some increase with the value component in year 2021. So please excuse me as I put my glasses on. So value, and I've been talking about this theme for years, actually about a year and a half or two, about 2.5, 3 years. Value is up 25-26% year to date, with growth, IWM, only up maybe 12% or so on the year. So our decision to tilt and lean the portfolios heavy into RPV, value, and IWN, Nancy, into value, definitely played off in 2020 and 2021. So we're really proud of that. And then the last chart I want to show you is UNL. UNL is a exchange traded fund that invests in natural gas. And you can see here that we had energy, right? So commodities. We have to protect ourselves against some inflation. And here it is. It's the end of the year, and I'm looking out my window, and I hardly see a speck of snow on the ground. But we've had again a multi-year decline in natural gas, primarily coming from fracking and the pipeline being open, quote unquote. Um, a huge abundance of natural gas, liquid propane gas in the economy during the previous administration. And what we're seeing here is we saw a breakout in 2021. Now we played this by buying UNL in the portfolio. So the market rallied, it had a pullback, and we bought it during the pullback. So we still have to let this thing play out. I think what we're going to envision is, despite this year's natural gas not really being a super cold winter. First of all, the jury is still not out on that. We have 3 more months of winter, and anything can happen. But I think thematically, crude oil is kind of done in terms of its rally, but natural gas, we think, is a really good contrarian play, because everybody focuses on crude oil and gas prices at the pump because we see it so much, but we're not really paying attention too much to natural gas in the big picture. And I'm going to pull up my last chart here of Bitcoin. I know you've heard me say so much about Bitcoin, and I do believe that it is the next big asset class. And so what we've had a pullback in Bitcoin from a high of around $65,000 to $68,000 per token. Statistically, it's kind of just in the middle of the range. There's not really much going on here. But again, as Bitcoin can be treated as the next new gold, Bitcoin is a interesting cash treasury management tool for companies and corporations. We're seeing that actively going forward with Visa, MasterCard, and MicroStrategies. We believe that Bitcoin is still the black sheep of the family in terms of having some allocation to a portfolio. But I truly believe with every fiber of my body that this is going to add spectacular gains to our portfolios in the next year or so. So please, I'm begging you, ignore the mainstream media news, ignore Fox News, ignore CNN, ignore the negative things that are going on in the conversation with Bitcoin, because they're designed to keep us out of this asset class. I don't think there is a greater, more exciting, we're getting in on the internet basically in 1994, 1996. That's what Bitcoin is like. And so we all have a little bit of that in the portfolios. So again, that's it. Just wanted to give you a quick recap on 2021 and what I see going to 2022. And we wish you a very Merry Christmas and a Happy New Year. If you have any questions, please don't hesitate to contact us. Thank you again.